The pound just hit 1.3535, a one-month high, and most traders are already calling this a breakout. But here is the trap. We are sitting directly on the yearly open, the single most important resistance level of 2026. And there is one danger zone and one hidden opportunity right now. I will show you both. Stay to the end because I am giving you 2 scalp plays and 1 swing trade you can execute today, plus the one headline that flips everything. This is your trader emergency call for GBP or USD. Here is the verdict. This is a trending market with a major resistance test. The session bias is bullish above 1.3460, but we are at a critical inflection point. The single invalidation level that flips the entire structure is 1.3343. Write this number down. If we break below 1.3343 today, the entire bullish structure resets and we are looking at a fast move back toward 1.3290. The herd is heavily positioned long after the 1.08% rally. Retail long positioning is stretched, and there is a massive stop cluster sitting just above 1.3550, where an estimated £1.3 billion in option expiries are concentrated between 1.3545 and 1.3550. This is where the smart money is watching for liquidity to sweep. Just this morning, Reuters reported that money markets are fully pricing a bow rate hike in November, with a second hike expected by March 2027. That is a hawkish repricing that fundamentally supports sterling, but it also means the good news is already priced in. Let us zoom out to the weekly chart first. Pound sterling to US dollar is attempting its most significant technical breakout in months after a 2.6% recovery off the yearly lows. The weekly trend is strong by across all timeframes. Daily, 4-hour, and 1-hour are all flashing strong by signals according to the technical summary. But here is what most traders miss. The weekly candle is testing the 61.8% Fibonacci retracement of the yearly range at 1.3591, with the May and August 2025 swing highs at 1.3593 forming a massive resistance clustered on the daily chart. Price is trading well above all major moving averages. The MA5 at 1.3343, MA10 at 1.3388, MA20 at 1.3366, MA50 at 1.3369, MA100 at 1.3390, and MA200 at 1.3374. The entire moving average cluster is now stacked bullishly beneath price. But the RSI at 65.91 is approaching overbought, and the MACD histogram at 0.002 is showing diminishing momentum. The Williams %R at -6.316 is deeply overbought. This is a classic divergence warning signal. Drop down to the 4-hour timeframe and you see the ascending channel that has contained price action for weeks. Price is currently trading near the upper channel boundary, with immediate resistance at 1.3509, the May 25th swing high. Above that, the 61.8% retracement at 1.3591 and the 2025 highs at 1.3593 are the next major technical hurdles. On the support side, the 200-hour moving average at 1.3375 is the first line of defense, followed by the daily low at 1.3343, the invalidation level I mentioned earlier. Here is the fresh insight from the web search. Forex.com senior technical strategist Michael Botris flagged that pound sterling to US dollar is approaching major resistance, and that a daily close above the yearly open would strengthen the case that a more significant low is in place. But failure to sustain the breakout would keep the broader downtrend intact. The battle lines are drawn at 1.3460 to 1.3474, the key resistance zone defined by the yearly open. The cross-asset linkage is critical here. The DXY dollar index fell 0.5% toward 100.40 after softer-than-expected U.S. wholesale inflation. The dollar is being crushed by the repricing of Fed expectations. Markets now see only a 10% probability of a July hike. This is the primary driver of pound sterling to US dollar strength. But if oil continues to rally on Middle East tensions, Brent is already pushing higher, that could reignite inflation fears and support the dollar. The correlation between oil prices and the dollar is the hidden variable most traders are ignoring. Let us connect the last 24 hours of core news directly to price action. Sterling is riding a triple tailwind that most traders are underestimating. First, US inflation. The June CPI came in at 3.5% year-on-year, down sharply from 4.2% in May and below the 3.8% consensus. Core inflation fell to 2.6%. Then PPI declined 0.3% month-on-month, with the annual rate slowing to 5.5% against the 6.2% forecast. This 1-2 punch has dramatically reduced the probability of Fed tightening. Fed Chair Kevin Warsh acknowledged he is not satisfied with inflation readings but described the labor market as broadly balanced. The market has pushed the expected timing of a Fed hike from September to late October 2nd, UK politics. The political risk premium that had been suppressing sterling for weeks has collapsed. Prime Minister Keir Starmer resigned 3 weeks ago, and the uncertainty over the succession had been holding cable back. Andy Burnham secured the support of the vast majority of Labour MPs and is expected to take office as Prime Minister on July 20th. This smooth transition has restored confidence in the UK's political outlook and squeezed the bearish positioning that had built up during the instability. Third, the Bank of England. The BO held rates at 3.75% in a 7-2 vote at the June meeting, with 2 dissenters pushing for a hike. Markets are now fully pricing a November rate hike, with a second hike expected by March 2027. Governor Andrew Bailey has made clear that rate cuts are not on the table. The UK inflation rate remains at 2.8%, with services inflation at 3.7%. Sticky inflation that forces the BO to maintain a hawkish stance. The yield differential is now supporting sterling. The UK 10-year gilt yield has risen 21 basis points month to date. The narrative web is clear. Policy divergence is widening in favour of the pound. The Fed is being forced to pause while the BO is being forced to hike. The 1 to 2 week directional lean is bullish above 1.3460, but the UK GDP release at 7 a.m. Thursday is the wildcard. Most economists expect GDP to have edged up by just 0.1% in May after slipping 0.1% in April. A beat above 0.2% would be a game changer. It would suggest the UK economy is more resilient than feared and could trigger a breakout toward 1.3640. A miss would expose the pair to a sharp correction. Do you think the pound breaks above 1.36 this week? Comment yes or no. I am tracking consensus. Most people skip this section. That is exactly where the money is made. Keep watching. I am giving you 2 scalping strategies and 1 swing strategy with exact prices, exact stops, and exact targets. Strategy 1, the opening scalp, scalping, high probability. The first strategy is the opening scalp, designed for the London Open or the New York session start. We are focusing on a 15-minute structural trigger right at a key intraday level. The trigger condition is this: price taps 1.3509, the May 25th swing high, and prints a bullish rejection wick or a bullish engulfing pattern on the 15-minute chart. This level has been tested multiple times and is acting as a magnet for liquidity. Entry 1.3515 after confirmation of the bullish rejection pattern. Stop loss 1.3495, just below the session low and the 200-hour moving average. Take profit 1.3550, the upper end of the option expiry cluster. Take profit 2, 1.3591, the 61.8% Fibonacci retracement. The risk-reward on TP1 is approximately 1 minute and 1.75 seconds. The scalp is voided if the 15-minute candle closes below 1.3490, which would indicate that sellers are defending the level aggressively. The opening SCALP entry, 1.3515, 15M bullish rejection wick at 1.3509, stop loss, 1.3495 take profit 1, 1.3550 take profit 2, 1.3591 risk, reward, 1:1.75 invalidation. Void if 15M candle closes below 1.3490. Strategy 2, the liquidity grab, scalping, counter noise. The second strategy is the liquidity grab. This is where we hunt the stops. We are looking at the 15-minute chart for a clear stop-hunt zone just beyond the session high. The setup, price pushes above 1.3550, triggering the stop cluster from the option expiries between 1.3545 and 1.3550. But instead of breaking out, Price reverses sharply and breaks back below 1.3535. This is the fake breakout confirmation, entry. 1.3525 on the snapback below 1.3535 with bearish momentum confirmation on the 15-minute RSI rolling over from overbought, stop loss. 1.3565, just above the wick high and outside the daily structure, take profit. 1.3465, the bottom of the resistance zone and the key retracement level at 1.34598. The risk reward is approximately 1 minute and 1.5 seconds. This is a fast scalp requiring quick execution. The entire move can happen in 30 to 60 minutes. Warning: this strategy requires fast execution and discipline on the stop loss. Do not chase if the breakout holds above 1.3550 for more than 2 15-minute candles. The liquidity grab entry. 1.3525, snap back below 1.3535 after 1.3550 fakeout, stop loss. 1.3565 take profit 1. 1.3465 risk, reward. 1:1.5 are invalidation, void. If 15M closes above 1.3560, are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Strategy 3, the session swing, trend alignment. The third strategy is the session swing, a multi-session position based on the 4-hour and daily bias. This is for traders who want to capture a larger move without the noise of intraday whipsaws. The trigger condition, a 4-hour close above 1.3509, the key resistance level, with the MACD histogram expanding positively and the RSI holding above 60. This would confirm that the breakout is genuine and that the bulls are in control. Entry. 1.3520 on the 4-hour close above resistance, stop loss. 1.3395, just below the 100-day moving average at 1.3390 and the 200-hour moving average at 1.3375. This is placed outside the daily structure to give the trade room to breathe. Take profit 1. 1.3640, the 2022 high and a major psychological level. Take profit 2. 1.3700, the stretch target if momentum accelerates. The risk reward on TP1 is approximately 1 minute and 3.2 seconds. Use a trailing stop once price reaches halfway to TP1. I recommend trailing at 1.3550 to lock in profits while letting the position run. Explicit invalidation. The swing is voided if the daily candle closes below 1.3343, the key support level and the invalidation level I gave you at the start. A daily close below this level would reset the entire bullish structure and suggest a deeper correction toward 1.3290, the session SNG entry. 1.3520, 4H. Close above 1.3509, stop loss. 1.3395 take profit 1. 1.3640 take profit 2. 1.3700 risk, reward. 1:3.2 are invalidation. Void if daily close below 1.3343. Never risk more than 1 to 2% per trade. Scalps demand even tighter risk. I recommend capping scalp risk at 0.5% of your account. No positions through high-impact news. That means flat or reduced size before the UK GDP release at 7 a.m. Stops are non-negotiable. If you do not set a stop, you do not take the trade. This is how you survive to trade the next big move. Let us summarize the single most critical level for the next session. 1.3509. This is the yearly open, the May 25th swing high, and the line in the sand for the entire bullish structure. If we close above this level on the daily chart, the path to 1.3640 and 1.3700 opens up. If we reject, we are looking at a fast fade toward 1.3343. Tomorrow's focus is the UK GDP release at 7 a.m. If this level breaks, and I mean a decisive break above 1.3509 with volume, the whole monthly trend flips bullish and we are targeting 1.38 by the end of July. I will have the updated blueprint 24 hours from now with the GDP reaction trade if you want the full breakdown on trading the Eurodollar, British Pound, Brent crude, gold, and Bitcoin. The videos are live now. Tap the end screen. Then hit the bell so tomorrow's alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter.